Hello and welcome to the latest Insider interview. Our guest today is Helen Steers, manager of the Pantheon International Investment Trust. Helen, thanks very much for coming in.
It's a pleasure, Sam. Thank you for inviting me.
So this is a private equity investment trust. Can you explain what private equity actually means?
So actually, private equity is just investing in the equity of private companies. So just as you would invest in a public company, but these are private companies, so not quoted on any stock exchange.
And for retail investors at home, this is often a hard to access part of the market. So why should they include it via a listed investment trust in their portfolios?
It is difficult to access because these companies are private, so you can't access them through a regular stock exchange. The reason why it's interesting is that these private companies are often faster growing, often in niches that are very difficult to access via the public markets. So it's a way actually of diversifying your portfolio and getting access to some of these really fast growing, exciting industry sectors. On average, if you look over the last sort of 20 years, private equity has outperformed underlying public markets by about 2 to 3% per annum. And that's one of the reasons, of course, why big institutional investors have large allocations to private equity, so the large university endowments, but also many pension plans, both public pension plans and corporate pension plans. So what's great actually about private equity investment trusts is that they provide the opportunity for anybody, for retail investors, independent investors, to have a slice of private equity, whereas in the past, it's really been the preserve of some of these big institutional investors. So it's kind of democratising the asset class.
And how do you go about investing in private companies, and what sets your approach apart from some of your peers?
So we've been going since 1987. So we have an established portfolio of private companies that is renewed all the time as we sell companies and then we acquire companies. And when an investor buys into the trust, they just buy a share of Pantheon International and they get access to this ready-made portfolio of private companies. Now, the reason we're different to some of the other private equity investment trusts is, well, first of all, we are globally diversified. So we're not just focused on the UK or on Europe. We cover all the different industry sectors, although we have a leaning towards information technology and healthcare. We're basically buyout focused, so these are more mature companies, so this is not a venture portfolio. And then the thing that really does differentiate us, I think, is that we invest for the most part directly into the opportunities which are shown to us by Pantheon, the manager. So we're not investing via Pantheon fund of funds. So these are direct holdings either in funds or directly into companies.
It's been going since 1987, as you said. So looking at returns, they've been fantastic. So 12% compound annual growth in the net asset value, about 11% in the share price. Yes. So what's been the secret to that success? Why have returns been so impressive?
Now, we're very pleased with the performance of the trust, as you've said, 12% net of all fees in terms of the NAV. And actually, over the last 10 years, that NAV performance has actually improved. So it's closer to 14%. It's 13.8% per annum net of all fees over the last 10 years. Now, I think the secret to the success of the trust is this global diversification and the fact also that we really invest with the best private equity managers, either in their funds or in the companies. And what's great about that is we get access to great private companies on a global scale.
And those private companies that you own, can you give some examples of some that have been, foundational to that success over the past, 30 odd years?
Well, I can talk about some of our biggest companies in the portfolio. So actually our largest company is a company called Action. So it's a private company, but it's the largest discount retailer in Northern Europe. So it's based in the Netherlands. They don't have any stores yet in the UK, but think of a kind of a super duper Poundland, but it's called Action. Now they've done incredibly well and they've still got more room to grow. There's a lot of white space in terms of more stores they can open and more types of products that they can sell through these discount stores. That's our biggest company. But also in the top 25, we've got the second largest ice cream manufacturer in the world. So they make private label ice cream for some of the big consumer brands. And then we've got a company called Visma, which is one of the leaders in software for SMEs. So it provides things like accounting software, payroll software, human resources software. It was actually originally started in Oslo in Norway, but has really expanded And then maybe for something completely different, we have a company called Smile Doctors, which is a chain of orthodontics clinics in the US. So it started out as a platform business, and they keep buying smaller orthodontics businesses run by single practitioners. And there, the idea is there is a lot of buying synergies. So if you're buying, your Invisalign and things like that, much better to buy it as a bigger business than as a single practitioner.
And what kind of sectors and companies do you like to own?
So we particularly like the more resilient and robust areas. So particularly software, enterprise software, because it's actually very resilient and it withstands a number of different macroeconomic environments. So what's great about things like accounting software, payroll software, human resources software, cybersecurity, is that the customers for those types of software packages, the SMEs, even medium-sized enterprises, really can't do without this type of software to run their businesses. So it's basically the last thing anybody would cancel after sort of turning the light switch off. So it's really important for companies. And I think the other interesting thing is that we've got great visibility into the revenues and earnings of those businesses because they're often sort of software as a service type businesses. Same with healthcare. I mean, healthcare, we're really sort of tapping into the trend there in terms of aging demographics. So a lot of the healthcare services and products companies we invest in are catering to that sort of aging population.
And this is a listed vehicle, so the share price can actually diverge from the net asset value. And at the moment, it's a 33% discount on the investment trust. Is that typical? And what explains this quite wide discount at the moment?
It is a wide discount at the moment, and usually the share price tracks the net asset value fairly closely, but there's been a divergence over the last 2 or 3 years, and I think that's really because of the macroeconomic environment, and there's been concern in general, I think, about M&A activity and about private equity sector. So we've traded at this relatively large discount in common with other private equity investment trusts, I have to say. Now, I think what's happened over the last sort of 12 months is that we've shown that actually our valuations are quite reasonable. In fact, when we exit businesses, even over the last 6 months, we've been exiting these companies, selling them at a higher valuation on average than the last holding value. And in fact, over the last 10 years, our average exit valuation is about 30% on average in excess of the holding valuation. So I think we've proven that actually the valuations are fine, the portfolio is doing well. I think this tilt towards these more mature businesses, where there's a very low loss ratio actually as well, has really stood us in good stead.
So that discount could be a buying opportunity then for people at home?
Well, we're always a bit reluctant to make any sorts of recommendations, but certainly we think that the portfolio is probably undervalued at the moment.
And so the NAV over the past couple of years, has that been relatively stable, or has that ticked a bit lower as publicly listed shares have actually fallen as well?
No, actually, I mean, our NAV has been ticking up steadily. And I think part of that is to do with the fact that we are invested more in the buyout part of the industry. So these are more mature businesses. And I probably should stress again that these are not venture businesses. We've got about 3% of the portfolio, which is in venture. That's a lot more volatile. So we saw that perform incredibly well actually during the pandemic, and then not so well coming out of the pandemic. But it's only 3% of the portfolio. About 71% of the portfolio is buyout. And there we see steady valuation gains and have done over the last 2 years.
And what happens when companies leave the portfolio? Are they listing on public markets? And what's the typical uplift to the NAV that you have marked down for that company?
So companies actually typically are sold to strategic buyers, so corporate buyers that are looking for growth. And as I've said, these companies are growth orientated. The average revenue growth actually over the last 5 years has been about 18%. And the average EBITDA growth, so earnings growth, has been about 19%. So these are fast-growing companies. Corporates buy them because they're trying to extend their product lines or their geographic coverage, and they need more growth. So that's the biggest exit route for us. And then the second biggest exit route is actually selling to other private equity funds. And our smallest exit route is actually IPOs. It's only about 10% of our exits historically. The average uplift over the last 10 years has been 30%. And the average exit multiple, so the multiple of cost that we sell these companies for, is about 3 times.
So investing in successful businesses that then go on
To be even more successful, actually, yes.
Fantastic. Helen, that's been very interesting. Thank you very much for coming in.
Sam, thank you very much. Pleasure to be here.
And that's all we've got time for. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.